Hello, and welcome to River Network's self-paced organizational growth learning series, focused on key topics for organizations growing their internal capacity. This series is best suited for groups who have already invested in their basic organizational structures, such as their mission statement, roles, leadership, and work plans. You can learn more about those topics by accessing our Organizational Health self-paced learning series. This episode is covering financial and legal infrastructure, with special attention to risk assessment and management. For those who aren't familiar with River Network, we work to grow and strengthen a national network of water, justice, and river advocates. We convene and build our network with training, resources, peer groups, technical support, funding, and in-person gatherings like our national conference, River Rally. River Network envisions a powerful and inclusive movement that ensures abundant clean water for all people and nature to thrive. Our work includes three focus areas: climate resilient communities, healthy and resilient rivers, and clean, safe, affordable drinking water. We work to build strong organizations and leaders across all of these focus areas, which is what brings us here today to talk about the key characteristics of a growing organization. At River Network, we know we do our best work in partnership with others. This video training series is a collaboration with the Hudson River Watershed Alliance, an organization in New York State that is uniting and empowering communities to protect their shared waters. Funding for this series comes in part from the New York State Environmental Protection Fund through the Hudson River Estuary Program, or the New York State Department of Environmental Conservation. Following the organizational growth checklist, we're now on the second topic, financial and legal infrastructure. We'll be approaching this topic through a lens of risk assessment and management. As we move through these topics, think about how they relate to one another. As a prompt for today's episode, pause and consider how strong communications from episode 1 can support managing different types of organizational risk. As groups and organizations become more established, leadership has to consider and implement new policies, systems, and procedures that will promote growth while instilling safeguards that protect the financial and legal integrity of the group. One of the first steps is to have open and transparent conversations around risk and how leadership will assess, evaluate, and manage it. We'll cover how to define risk for your group or organization, types of risk you may encounter, and ways to think about managing it. Basic ways to define risk include the possibility of loss or damage and exposure to hazards. In the case of nonprofit organizations and community-based groups, risk can encompass financial liabilities, accidents, disasters, reputational risk, general liability, or errors in management. Leaders of organizations are responsible for identifying and assessing the comfort level of the group, where they might be vulnerable, and how it can be reduced and managed. When it comes to risk, organizations have the following options to consider. They can assume and accept a certain level of risk. They can assume the risk and control the level of risk through legal guidance, insurance, and internal controls. They can decline and share the risk by transferring the risk to another party, or they can try to avoid the risk altogether by changing strategy or actions. Regardless of the organization's comfort level with risk, they should put measures into place to monitoring the level and exposure of risk through documentation, evaluation, and standard operating procedures, or SOPs. Before we get much further, let's briefly cover what each type of risk can look like. General liability includes all of the harm that could be caused to others through your operations or actions. Think about personal injuries, property damage, or personal harm that could come from any of the activities your group organizes, including volunteer activities like cleanups, stream monitoring, or planting events. This type of risk is often managed through a general insurance policy. Financial risk includes debt that your group may incur, including short-term debt that is reimbursable, as well as contractual obligations to utilize grant funding or restricted donations the way they are intended to be used. Good financial procedures, controls, and role definition helps manage this risk. Some financial risk can also be transferred and shared through outsourcing to a bookkeeper, third-party grants manager, or other financial services professional. Reputational risk can be very unique to each group or organization, but this type of risk includes any fallout from breaking commitments, not being dependable, falling short of expectations, or other organizational inconsistencies. Essentially, what will happen if you don't do what you say you will? This type of risk can be associated with funders, members, donors, or the broader community feeling like your group didn't follow through on what you committed to. Strong, clear, and proactive communications can support managing this type of risk. Transitional risk comes with leadership changes, whether it's in staffing, your board of directors, or other positions. When people leave, we often see institutional information, relationships, and sometimes even physical assets go with them. Thorough record keeping, document management, and exit interviews support managing this type of risk. The last type of risk we'll cover is accidents and disasters, which are outside of your control and can only be managed to a certain degree. External forces can impact our work and operations beyond our control, but we can still have safeguards like an insurance policy to lessen the blow. One thing to keep in mind, risk isn't necessarily bad. We all have risks associated with achieving our mission-driven work, and sometimes those risks come as a result of growth opportunities, like having a large grant or bringing in fresh leadership. While we do want to minimize and manage risk, it's not our job to eliminate it. Groups that are willing to assume and accept risk associated with their mission-driven activities may want to consider a basic insurance policy, especially basic liability coverage, to protect the organization when hosting volunteers and programming that could introduce harm. If you are not an incorporated organization, meaning that you don't have your own legal status, you can talk to organizational partners about using their insurance for co-led events, which might include being listed as additionally insured on a liability policy that a partner organization holds. For those who are interested in understanding what policies can cover, how much they cost, and what kinds of options are available, Nonprofit Insurance Alliance is a trusted organization that works with groups of all sizes and budgets. Often, groups have to assume and control their risk with internal policies and procedures. Things like waivers and standing operating procedures, or SOPs, help us achieve this. One of the most important aspects of controlling risk is having proper documentation of policies, events, and attempts to reconcile and manage risk when things go wrong. Standard operating procedures should be reviewed and updated on a regular basis and stored somewhere that staff, volunteers, and leadership of any kind have easy access to. Consider reviewing these policies every other year to ensure they are meeting the group's needs. Written policies and procedures that you should have on file and use regularly include procedures addressing when to secure liability waivers from volunteers, including where those waivers are kept and how long they stay on file, who is permitted to speak on behalf of the organization or represent the organization at public events, how the group will determine if they take an advocacy or policy position, including who's involved in making that decision, things like financial authority and access procedures, as well as document management and access procedures. Because organizations are frequently sharing documents online through email or shared drives, we want to provide some additional context about document management. Many of the documents groups rely on for operating exist online and have shared access in cloud-based file systems. Access to those documents may lie with personal emails, work emails, or group and organizational suite emails. Any of those accounts may become hard to access or just outright disappear when a person leaves their role. To minimize access risks, organizations should make sure that online and cloud-based file sharing systems are regularly checked for access, including who has access, what they have access to, and what level of access they have, such as viewing access, editing access, or content management access. This is particularly important when folks leave a group or organization. Also consider updating multi-factor authentication regularly. Who and to what device is that authenticating to? Groups should have a secure password storage system, similar to a program like LastPass. Storing passwords in a shared document or spreadsheet, while simple, is a fairly insecure way to do that and opens the door to many unnecessary risks. When it comes to sensitive information like names paired with contact information or financial contributions, move those things to a more secure place than regular file sharing or restrict who has access to the contact lists. These things are actually best stored behind a multi-factor authentication system. And if you take donations or have services that you charge fees for, completely avoid storing payment information. Third-party vendors do this and assume the risk for it. Much of the conversation around financial management controls is related to document management. It's a specific extension of the questions around who has access to what. Be sure to define financial and budgetary roles and responsibilities through written documentation and ensure everyone in the group understands those roles, where to access information about them, and ideally is trained to a certain extent on their involvement with financial oversight. Organizations should consider addressing the following questions through policies. When the group or organization receives funds, who is in charge of getting those funds where they need to go? Who has access to financial records? Who has access to bank accounts, credit cards, checkbooks, and other means of performing transactions? Who's responsible for tracking funds or doing bookkeeping? And who do they report that information out to for accountability? How often are basic financial tasks being completed and who is ensuring they are done? Is their completion tracked somewhere to ensure accountability? And lastly, if an external contractor or other support person is involved, what kind of accountability structures are in place to ensure they accurately deliver their services? In this case, this is a transfer of risk to a third party by outsourcing the role, but they still need oversight from leadership in your group. Often, many of these financial roles go to a treasurer, but a treasurer still needs a support system and accountability structure. No single person should be the sole keeper of financial knowledge. The last internal policy we'll discuss when it comes to assuming and controlling risk is a conflict of interest policy. A conflict of interest, often abbreviated as a COI, is a situation in which a person or organization has competing financial, personal, and professional interests. Local groups and organizations often engage with individuals that may serve on multiple boards or support multiple organizations at the same time. To avoid unnecessary complications and conflict, organizations should have a conflict of interest policy that addresses financial and non-financial COIs. To help acknowledge and minimize these conflicts, require everyone to complete and sign a conflict of interest form. Consider updating these regularly as folks' roles in the community can change over time. If there are abundant conflicts, consider transferring the liability of a conflict of interest by outsourcing or contracting those tasks if possible to partners outside of your group or organization. We've talked a bit about assuming risk through insurance, assuming risk through internal controls, and named some specific examples of transferring risk through third-party or external support. The last tactic to cover is avoiding risk. Organizations can minimize risk, but it is incredibly difficult to avoid it altogether. Going beyond instituting controls, organizations can avoid activities and tactics that are labeled riskier than others. One specific type of risk to be aware of is reputational risk, which can be brought on by a host of activities and opportunities, but often boils down to saying yes to too many things and failing to deliver on them, or stepping outside of your mission-driven work. These activities can include, but are not limited to, participating in policy and litigation activities. While 501c3 organizations can legally lobby, draft legislation, and be party to litigation activities, it often opens their organization up to reputational risk and necessitates some knowledge of status compliance. Entities that participate in these activities will need to navigate possibly difficult questions from donors, volunteers, corporate sponsors, and others. Drafting policies that make it clear donations do not influence the organization's position on policy statements can minimize confusion and reassure supporters that the organization cannot be bought out or influenced. Another thing to consider is partnering with corporations or other entities that have complicated relationships with local communities. Some of these may be obvious, but some may not. Find out if a corporate sponsor or business is aligned with your group's values and mission. Furthermore, investigate what else they support. The last thing we'll mention here is large fundraising campaigns that include fiscal sponsors, matched funds, or delayed use of funding. These all tend to increase risk. A communications plan and proper fiscal sponsorship documentation can go a long way to ensure that the funds people donate to you are available and used as intended. These activities on their own are not inherently risky, but they can invite risk if not gone about strategically. There are other activities that you might identify as risky for your specific group. Pause for a moment to write them down and consider having a conversation with your group about the cost and benefit of taking those on. Are they worth the additional thought and procedure, or do you just want to avoid them altogether? It is much easier for groups and organizations to proactively implement safeguards while they grow, rather than waiting for issues to arise and reacting to them after the fact. To recap this episode, we have talked about defining and assessing risk for your group, the types of risk your group might engage with, and ways to manage risk through assuming and accepting it, assuming and controlling it, transferring and sharing it, or avoiding risk altogether. The next episode in this self-paced learning series will cover leadership transitions and succession planning. We will follow up on several of the SOPs mentioned in this episode, because in the event of leadership changes, you'll rely on those procedures for a successful transition. Reference the organizational growth checklist prior to watching episode 3 for a simple introduction to the specific topics covered. Thank you for watching the second episode in the Organizational Growth Self-Paced Learning Series. To learn more and access additional free resources, visit rivernetwork.org.